Welcome. I'm Vivian Schmidt. I'm Jean Monnet Professor of European Integration at Boston University and chair of the study group on the future of the EU. I'm delighted to be chairing this panel on the future of the euro. Having been on leave and in Berlin at the height of the crisis and its buildup, and at the time worrying greatly about not so much the future of the euro as the future of the European economy more generally, I'm delighted that we're going to find out what the future is, not just of the euro, but the European economy. This panel will consist of, and I'm going to introduce people in order of their appearance. The panel will begin with LOUKAS TSOUKALIS, who's Jean Monnet Professor of European Integration at the University of Athens and president of the think tank IMAP. He's also special advisor to Barroso, although he tries to deny that. And he has a forthcoming book, The Delphic Oracle on Europe. It's coming out in OUP in the spring 2011. That's an edited book. Next, we're going to have Jeff Frieden, who's Stanfield Professor of International Peace in the Department of Government at Harvard. He also has a forthcoming book with Menzi Chin entitled Lost Decades, The Making of America's Debt Crisis and the Long Recovery. That's forthcoming with Norton in 2011, but he tells me that we're not supposed to know about this because the publisher doesn't.
No, you're supposed to remember it.
Oh, sorry.
When it comes out.
Okay, remember it, so go to Amazon.com now and order. Next, we have HANS-HELMUT Kotz, who's visiting lecturer in the Department of Economics at Harvard University and former member of the executive board of the Deutsche Bundesbank, who is in charge of financial stability, markets, and statistics. He's also a consultant for the OECD, and he has recently written a report for the Bank for International Settlements. So what we can hope is that he will give us an inside view of the Bundesbank's view on tricher. Or perhaps we don't want to know that.
Turn the mics off.
Right.
You
Okay.
don't wanna know.
We don't want to know. I was afraid of that. Next, we have Michael Londisman, who's Pierre Keller Visiting Professor of Public Policy, Harvard Kennedy School, and he's Scientific Director of the Vienna Institute for International Economic Studies. And he told me he doesn't want any more said about him. And finally, Jacques Mistral, Head of Economic Studies at IFRI, the Institut Français des Relations Internationales, who actually has a book that recently came out entitled La Troisième Révolution Américaine, the Third American Revolution. Clearly, this was about Obama 2 years ago, and presumably that book is out of date already, unfortunately, or perhaps not. But we'll have to have another book in 2 more years to find out the fourth American Revolution. Okay, what we've asked the panelists to do is to give no more than 5 to 7 minutes of comments for a first round. Then there'll be a next round, which will be open up to debate amongst the panelists, and then the final round will be open to the general public. And I think without further ado, we start with LOUKAS.
Thank you, Vivian. Crisis is often the mother of change, and crises have in the past worked as a catalyst for further integration in Europe. It has happened several times in the past, and it is likely to happen again. There's already evidence of both change and further integration in response to the crisis that we experienced in the first half of 2010. The big question that arises is whether the change and the further integration are economically and politically sustainable. And the answer to that question will largely determine the future of the euro. So that's my main thesis, and I will try to elaborate on it in the next 4 minutes left. So change is indeed happening, not only at the European Union level, but also in individual countries. I mean, I come from a difficult country named Greece, and Greece is experiencing reform measures and fiscal stabilization measures that would have been completely unthinkable 10 months ago. They're happening, and the government is still there, and I suppose there's more to happen. Fiscal consolidation is also taking place in an increasing number of European Union countries. And at the same time, we have begun a process of reform and strengthening of Euro governance structures in response to the crisis, which comes in the aftermath of already pretty remarkable decisions about setting up a support mechanism for Greece and about the creation of the European Financial Stability Facility, which again, if somebody had told you that the European Union would have agreed on 110 billion euros for Greece, your answer would be you're mad, but it's happened. And then this was followed by another decision for a European Financial Stability Facility, which together with the IMF will reach or may reach, if the need arises, the order of 750 billion euros. So, and we had the European Council meeting last week, which has set the path for the strengthening of Euro governance, including more binding coordination of economic policies, extending the scope of coordination, more biting sanctions, more effective surveillance, and very likely also a permanent crisis mechanism. So this is the evidence for change and reform. Now, is that sustainable economically and politically? Now, economic sustainability. The first point to bear in mind is that those things are happening while there is considerable divergence of views and economic performance inside the European Union. There is divergence of views about the timing of exit strategies and about the appropriate dose of fiscal reflation. There is much disagreement on this side of the Atlantic. There is quite a lot also on the other side of the Atlantic. Yet, the choice with the emphasis on fiscal consolidation has been taken not so much by consensus, but I would say, to put it politely, by default. It's been dictated essentially by financial markets, which have become increasingly worried about rising sovereign debt. I very much hope that financial markets with this time will prove to be wiser than they proved to be in the period pre-2008. And the same tune is also sung by the German government. So the economic sustainability of a process on which the emphasis is on fiscal consolidation, and there is no serious discussion as to how you distribute the burden of adjustment between surplus and deficit countries, is predicated on the survival of a rather fragile economic recovery. If the economic recovery is not sustained in Europe, then much of all that will be hanging up in the air, and the situation could get increasingly unpleasant, because in some countries, and not only Greece, we may be testing the thresholds of tolerance of societies and economic systems. Now, political sustainability, of course, we will be with decisions for more binding coordination of economic policies. We will be testing the new frontiers of shared sovereignty and limited parliamentary sovereignty in the European Union. And I have nothing against that in principle, but the question is whether this becomes politically feasible, especially at a time in which there is rising populism in an increasing number of European countries, and certainly not only European countries, but also on this side of the Atlantic. And of course, economic sustainability is closely interrelated to political sustainability, and I will finish.
Perfect. Thank you very much. Right on time. Next we have Jeff Frieden.
Okay, I'm not sure I'll try, but I'm not sure I'm going to be quite as succinct as Lucas. What I wanted to do is look at the past to try to see if we can get some guidance for the future, and in particular look at some of the social science analyses of the process of European monetary integration, in particular political economy analyses of the process of European integration, to see what they might tell us about possibilities for the future. And in particular, look at what scholars identified as tensions or pressures or issues in European monetary integration in the run-up to the euro, in the 20-year process leading eventually up to the euro. And I want to specify here that I'm not flagging tensions or problems or pressures in any normative sense. as a Eurosceptic or anything along those lines, simply because I think that understanding where the pressures on policymakers are coming from and where they're likely to come from, we get a better sense of what the future is likely to bring. There are 4 dimensions that I'd like to focus on. And again, to clarify, these are dimensions that were talked about, have been talked about for at least 20 years as scholars have thought about what the issues are likely to be in the process of European monetary integration. And I guess there's a triumphalist tone in some sense on my part, because the things that we identified as being crucially important to understanding the process of European monetary integration have in fact turned out to be crucially important in the past couple of years as the crisis has worked its way through. First dimension, the problems of a common monetary policy for a highly diverse and heterogeneous set of national economies. Now, this was very obvious in the run-up to the crisis, where one of the sources of the intra-European diversity and of the crisis within Europe, in particular the crisis in the southern European countries, was that a monetary policy which the ECB had to devise for Europe as a whole was almost certainly inappropriate for southern Europe. And in particular, it probably led, as has been talked about in the American case, to a monetary policy that was too loose for countries that were growing very rapidly. So that you had, because you have a common interest rate, you had interest rates that may have been appropriate for northern Europe, but that meant, given the different level of price inflation, meant negative real interest rates for much of southern Europe, in particular Spain, and therefore encouraged the very large borrowing boom that Spain, like other countries, like the United States, embarked on. Now, we face a similar set of tensions in the process of adjustment. That is, the monetary policy that is appropriate for Germany may well not be appropriate for a country like Spain, which is undergoing a very, very difficult adjustment process. Now, this is a common problem with common currency areas, including the United States. But I think the tensions will be heightened by the very high levels of unemployment and the depth of the crisis that different parts of the Eurozone are experiencing. So that's the first dimension, common monetary policy, heterogeneous national economies. Second, common currency with heterogeneous national financial systems, and in particular heterogeneous, very different national financial regulatory regimes. The problem here, flagged long ago, was the prospect that a serious financial difficulties in one national financial system, the responsibility of national financial authorities, would cause serious problems, impose costs on, impose externalities on other members of the Eurozone, and in particular would lead the central bank for the Eurozone as a whole to have to pursue a monetary policy that was aimed at trying to reduce the impact of a country-specific financial crisis in the context of a central bank that's supposed to be acting on behalf of the Eurozone as a whole. And that is more or less what we've seen in the ECB's attempts to respond to first the Irish and the Spanish financial difficulties. All right. Now, again, these are extraordinarily important tensions. The ECB has handled them, I think, about as well as could be expected, but they are going to continue to be tensions in a Eurozone made up of highly diverse financial systems, facing highly diverse conditions in highly diverse regulatory circumstances. Third dimension, a common currency with different national fiscal authorities, and in particular with different sovereign debt issuers. This is what was all through the 90s known as the bailout problem or the moral hazard problem. That is, you have a common currency, you have a common central bank. There is a clear incentive for member states, and in fact, to some extent, to the extent that country risk feeds into or that sovereign risk feeds into country risk for individual private borrowers, for private borrowers from particular countries, to take advantage of the implicit notion that the common central bank would have to act to address sovereign debt problems in a particular member. And the Greek sovereign debt problem is a very obvious instance of this, where it is almost certainly the case that Greece took advantage of what was seen by the markets as an implicit guarantee or implicit willingness to back up Greek sovereign debt on the part of the ECB. Or, to put it a little bit differently, and this is not a criticism of the ECB, to put it a little bit differently, the notion that the ECB would have to respond in a monetary policy sense to sovereign debt problems in a major member state by helping work out some sovereign debt worked out, which is exactly what happened. Right? So the members of the Eurozone were, in a sense, in exactly the same way as American authorities were with the too big to fail doctrine, over the barrel, were pushed over the barrel by both the member states and by the markets, which took advantage of this expected bailout. A very serious tension, and one that is they're attempting to address through some of the measures that Lucas referred to, but will continue to be a problem in the going forward. So I've mentioned three sort of negative things, but I also want to mention a positive aspect, a positive dimension that was borne out, I think, by the crisis, and that is that in the 15 or 20 years leading up to European monetary integration, a lot of scholarship focused on the fact, underappreciated by many, especially in the US, that there were some very important positive effects of monetary integration that were typically not captured in some more static models of currency unions. In particular, that currency unification had a powerful dynamic effect on economic integration more broadly, in particular in trade and investment integration. Andy Rose was most famous for a study that indicated, with some controversy, that countries in currency unions had 3 times the level of trade among themselves as countries not identical or similar countries that not in currency unions. And so the positive impact of this currency unification, which was typically underplayed by American scholars, I think was highlighted in some of the discussions and some of the response to the crisis as it eventually unfolded, because what we observed was that there was, in fact, an extraordinarily positive assessment of the impact of currency union throughout the union. Now, despite all of the controversy, despite all of the public outcry in countries like Germany, I think what we see in a revealed preference sense is that countries like Germany came to appreciate the stimulus given to export markets, overseas investments or investments within the Eurozone by the existence of the euro. So the positive impact of currency unification, I think, was highlighted by the positive response of the political economies of the Eurozone to the crisis that erupted. So those are the 4 dimensions that were identified in the years leading up to European monetary integration, I think borne out by the crisis. And I think, you know, looking forward, that the way that the Eurozone addresses these 4 dimensions of tension or pressure will tell us something about the future of the euro.
Very good. Who's next? HANS-HELMUT Kotz.
Thank you very much. I was tempted to misunderstand the title. Future of the euro could lead an economist to think about forecasting the euro. And then I was also tempted to quote J.P. Morgan, who once said, well, forecasting currencies is easy. They will fluctuate. In the euro's case, you've seen, by the way, in terms of forecasting, funny things happening, and we also frequently try to retrofit our history, our stories to what is going on. I recall very well last big crisis of the euro, when we talked about the future of the euro, was in 2001. In fact, at that time we had an article in a major German newspaper with the title, Europa ist so viel wert wie der Euro. Europe is as much worth as the euro. And actually the author wanted to tell us that the euro would go down the drain. It was at that time at 80 cents to the dollar. It went up to, well, just last year to 160. But apparently nobody misunderstands the title or the headline of this panel as I did. I'd like to make 3 remarks. They have to do with some of the tension which were alluded to by Jeffrey. The first is heterogeneity, and hence, which he didn't say, but almost said, implicitly, it would be good for those small open economies to have their independent national monetary policy. I completely disagree. I completely disagree. Just put it into the context of one of those 3, 4, 5 small, medium-sized open economies. What the response would be from the side of markets if they would have their independent, autonomous monetary policy. History is useful device there. Just look back at spreads of debt of those countries where you had not only an implicit devaluation premium of to a significant degree, but also this time around you would see a substantial default premium incorporated in those spreads. What would that mean? Well, it would mean that, of course, not the real problems would be addressed, but you would with nominal exchange rate, just possibly only cushion some of the shocks. But as far as these are real issues, an autonomous structural issues, an autonomous monetary policy would be of no avail, basically. You could use nominal exchange rate usefully under two conditions. First, a temporary shock, not a permanent shock, and a structural, and not a structural one. But what we see there is, of course, very much structural issues. Nominal exchange rate, autonomous monetary policy wouldn't help out there. I have to confess, I should have started with saying I'm not talking for the Bundesbank anymore, but that was pretty close to what I used to say, and what my colleagues will say going forward. The second point, which I would like to address, has to do with debt insustainability. First of all, we should, of course, not disregard that this shock which we've seen, which is really a massive one, almost historically unprecedented, almost, that this shock is a shock emanating from an over-leveraged private sector. So a significant part of the debt buildup, which we now see, is coming from the substitution which took place between private sector debt and public sector debt. And there, almost all of the countries are in pretty dire straits. They have to adapt. If you look at debt levels, and if in particular look at the difference between real interest rates and real growth rates, it's evident that these are unsustainable. Now, the preferred solution of many American economists to have an autonomous monetary policy is simply orthogonal to that problem. It doesn't help at all. With this gaping hole between revenues, structural revenues, and structural expenditures, there's no way out but, well, to adapt. And that will take either higher taxes or lower expenditures. And last remark, I hope I'm staying within my time limits. I couldn't have imagined things which we now see in terms of institutional innovations going on without, and that's why it's so useful for member countries to be within the constraints of European Monetary Union, without these constraints. And let me end on this one. It would be completely irrational for those countries to even ponder the option of restructuring, or even worse, to ponder the option of getting out of EMU, and it would also be pretty nonsensical for Germany. And Jeff made very correctly that point. Germany is one of the major winners of European Monetary Union. Here with Germany, I mean small and medium-sized companies who have a stable market without uncertainty, which allows them to produce economies of scale and scope, and which makes them competitive. They would lose massively in terms of competitiveness if they would opt for the preferred option of many economists, namely going for more uncertainty. Thank you.
Great. Very much on time. Michael Londisman.
Well, we just experienced the interesting elections, at least for us from outside the US, and there was a lot of talk about the founding fathers. And I was thinking, well, they sat together for a certain amount of time, came up with something, and it was reasonably robust for the next few hundred years. In the EU, one can't say the same thing. It was neither was the framework fully reasonable, nor was it robust. It wasn't reasonable because there were intellectual deficiencies from the very beginning, and I think not only with the policymakers, also with the academics or the disciplines which were behind the setting up of the Eurozone. It doesn't mean that learning through crisis and learning by doing is not a bad, might not be another path to come to something positive, but it was clear that certain issues were not taken seriously. And I think even in the reactions to the crisis, you still see certain biases and neglect for certain areas which will come back with some vengeance, or we haven't found any recipes. I think, let me be more concrete. I think there was a singular attention from the very beginning of setting up the EMU to deal with fiscal issues. There was a very strong concentration on developing both as entry requirements as well as how to conduct oneself within EMU to focus on fiscal criteria. Now, there were two areas which should have been obvious from the beginning, which were neglected and came forth very much during the crisis. One was when you increase dramatically the degree of financial market integration, you should do something about governance structure of financial market regulation supervision. And I think both the academic disciplines, but also the policymakers ignored that for a long time. And I think you can still see in the current debate the very strong focus is still on fiscal criteria. The other one, I think it was already mentioned by Jeffrey Frieden, is that there was, of course, an underlying knowledge that issues of external imbalances still will continue to play a role within an integrated European Union. So if countries build up debt, whether they are public or private, it is in that sense threatening stability within the countries, but having spillover effects. So the issue of competitiveness within the European Union, there was a lot of things written about competitiveness, but not the macroeconomic and stability implications of severe divergences of competitiveness within the Eurozone was not sufficiently tackled. Now, where are we now in terms of dealing with these issues? I think on the financial market side, we see a lot of proposals being generated. And I think the big issue, of course, here is to think about something which will be there for the longer term, but at the same time to deal with the rather vulnerable situation in which the European bank system finds itself at the moment. So quite a few of the things which should be instated for the longer run have costs in the short run in terms of making the bank system even more fragile. In fact, the danger in the European financial system is much more than even in the American one, is a Japanese scenario with a delayed process of bank restructuring, recapitalization of banks, etc. One underlying cause of that is, of course, that regulators are still segmented. And in fact, what is seen by, let's say, an Austrian regulator or supervisor as being a systemically relevant bank might not be very systemically relevant at the EU level. So I think the problem of operating regulation supervision at the EU-wide level also retards the process of bank restructuring. On the competitiveness side, I think we are far away from having found the recipe of how to deal with it. One part of it, of course, might be linked to financial instability in a sense that nobody would accuse of Ireland to be a very uncompetitive economy. Nonetheless, it ended up with a severe crisis. And the reason was financial market problems, enormous influx of funds, a huge credit boom, which then led to private sector debt and then internalization of that private sector debt into a fiscal debt situation. So I think the handle of constraining countries purely on the fiscal side is not dealing with that. So I think if a tighter financial regulation can deal with that, with some of these aspects of imbalances developing within the European Union, that is fine. However, it goes beyond that. We know that countries also have chronic structural imbalance on competitiveness problems for a long time, even within countries, and we haven't found the recipe to deal with that. There's some talk about it, always in a very vague way, about flexibility of labor markets, wage adjustment, and so on, but we have the European economy as it is, so I think all these processes are very long-run, they're long-run process of changes, and we don't jump to a different scenario in this respect. So I think we don't have a proper solution for that second aspect, which of course is now taken very seriously, but I think the recipes on the table are basically about monitoring issues of competitiveness. Finally, I think on the fiscal side, there are again a lot of interesting and good ideas on the table. It was quite well known amongst economists that the setup from the very beginning did not make much analytical sense. I think the issue is for fiscal sustainability and not flow criteria such as the fiscal deficit. I think some of the interesting ideas go in the direction of more renationalization of the issue of fiscal sustainability in terms of delegating things to fiscal policy authorities or fiscal policy committees, which are done at the national level. Because the legitimacy of imposing strong discipline from the EU level would not be accepted politically. So in that sense, I think there are also interesting proposals on the table where some degree of more technocratic control over sustainability issues at the national level and an exchange of views and acceptance of best practices in this respect can deal with that issue. Thank you.
Very good. Jacques.
Thank you. At the end of a lunch I had with Jeff, he told me that I was exaggeratedly pessimistic, and that was correct. But the good news is that I used all my daily dose of pessimism, and now I can speak very positively about the question which is raised, the future of the euro. Let me start with a recent experience. I had to be in Berlin last Friday for a Franco-German meeting, and that was the day following the summit in Brussels of the leaders. And the FT on Friday morning was entitled Chancellor Merkel Defeated. Well, I thought the atmosphere of the meeting will probably be sensible to this situation. The reality is that 2 hours later, it was known that the summit was a success and that a consensus had been reached in the middle of the night about what was initially called as a basis as the Franco-German compromise in Deauville. There are 2 lessons from this experience. Number one, there is something that the Financial Times and more generally the financial press and more generally the Anglo-American public doesn't understand about the euro process, and which was very well emphasized by Jeff. It is that the benefits of the euro within continental Europe, to simplify, the benefits of the euro are generally significantly underestimated. This is true regarding the argument concerning integration, which has been made by Jeff, but there is another element which is extremely important. It is that wouldn't we have the euro, we would have known the chaotic situation we have experimented in the past. And everyone from Greece to France and to others know a lot about this. So these common interests have a very simple consequence. The prediction in the spring that the end of the euro was a question of year will prove completely wrong, because these common interests will, at the end of the day, always conclude by a compromise. And this is why I think positively to the new architecture which is being put in place, which briefly mentioned by LOUKAS. Naturally, it's not the American Constitution. It's not perfect, because anyone at the beginning was willing different things. So it's mainly, besides the European Central Bank, it's rather a confederation. It's pieces and pieces, and it works more or less. And every crisis is an opportunity to add some piece. But the important thing is that pieces are adding each after the preceding one. The process is not accumulating tensions, in my view. It's accumulating progressive solutions, answers to the present challenges. And in the present situation, I think that regarding this architecture to have a better situation in the European governance, we should put emphasis on the quality of data, because at the beginning of the Greek crisis is the misperception of the reality of the situation. So we should have a better statistical and measurement tools. We should have more independent evaluations of the situation of the country. We shouldn't have political sanctions, as it is frequently proposed. It is proposed by the Germans. We shouldn't have political sanctions because it's something which doesn't exist to solve financial crisis. Sanctions doesn't belong to the vocabulary of the IMF. It's conditionality, but political sanctions, in my view, is a nonsense. Well, to conclude, I would say that in the spring, many commentators said that the major problem of Greece was that being part of the Eurozone, the Greek currency could not devalue. And Martin Feldstein, for example, proposed that the Greek come back to the drachma and may finally be able to devalue. This was a wish I wouldn't share to the Greeks. And in effect, the result of the judgment of the markets was a depreciation of the euro, which come down to 120 in between the two extremes which have been mentioned, to 120 in June. At that time, I said to my financial friends, it's a good timing to buy euros because the future will prove that the euro will be perceived as the best managed in the world. We have the region of the world where we have an independent central bank which is wary of difficulties. It has proven to be up to the task when facing the crisis, but doesn't want to enter excessively dangerous paths. And we have a process of fiscal consolidation, which is going quickly and strongly for countries which are definitely in need of rapid fiscal consolidation, but which is going cautiously and slowly for major economies which have to do it for the medium term. So to conclude, the future of the euro, I would not make a prediction because it will always fluctuate, but I fear that the next phase is an upward fluctuation. Thank you.
Thank you very much. You've been incredibly disciplined panelists. And what I've decided to do is that since I'm the lone political scientist amongst all economists or no, okay, not the only one.
Me?
Okay, no, and LOUKAS is going to say the same thing. But, okay.
Do it anyway.
The person more focused on the politics of the economics than the economics alone. I thought what I would do for the rest of you is actually focus on a couple of questions that I think are that you've sort of hinted at, that I think you have answers to, but you haven't really focused on. And the one is, I have three questions here, but the first would be the move to austerity across Europe. Is this a good thing? I think that there are differences amongst you, but that hasn't come out clearly. So the big question is fiscal consolidation as the EU is going now, is that the answer? And how fast? Is a 6-point drop, for example, in deficit a good thing for all of the countries of the South? And we've heard a lot about stability, but what about growth? This is question number one, and I leave it to panelists to respond as they will. Yeah, Jeff.
Well, I can try to respond to that. I was going to try to respond to some of the things that HANS-HELMUT said, actually, but I'll try to do both. And, so I want to make sure that I'm not misunderstood. I certainly wasn't making an argument either for or against the euro, but I do want to, and I'm not sure I understood exactly what HANS-HELMUT, what his argument was, but perhaps I can stylize what at least as a debate, I'm not sure if it's the debate between him and me, but a debate, and that is to what extent was the existence of the euro and of a common currency responsible for the nature and character of the crisis within Europe. And what I think I heard HANS-HELMUT saying is not very much because it's really driven by structural and real causes, and I would give a very different answer and say almost entirely. That is, that the European nature of the crisis is a microcosm of the global crisis, and just as the global crisis was born out of global macroeconomic imbalances, the intra-European crisis was growing out of intra-European imbalances. And there are a number of dimensions. The first is monetary policy. You have very rapidly growing countries, Spain and let's just take Spain and Ireland as examples. Spain and Ireland are growing very rapidly. The real interest rate is negative in these cases. The incentive to borrow is extraordinary. And so you get a virtuous circle, I suppose, in some senses, where the incentives to borrow, you have a huge buildup of debt in Ireland and Spain. None of it public. There is no public sector deficit in these countries. This is not a public debt problem. This is not a structural fiscal problem. This is a private sector problem with, in the case of Spain, the most tightly regulated financial system in all of the OECD. Right? So this is a macroeconomic problem. Second, the borrowing largely responded to the bailout issue, the moral hazard issue. That is, the common currency gave incentives for both private borrowers and especially public borrowers to take advantage of the common currency, the implicit guarantee, or the understanding that there was an implicit guarantee, to overborrow. And that's what they did. And for that matter, I don't want to put the blame on both sides, to overlend. Because it was not only the borrowers that were taking advantage of the implicit bailout, it was the lenders, the German banks and others who made these substantial loans to Southern European borrowers. So I guess I would say this is a European macroeconomic imbalances, and macroeconomic policy, in particular monetary policy, was absolutely central to it. That is not an argument against the euro. I'm not a Eurosceptic, and I don't think the euro was a bad thing, and I don't think that Spain should have readopted the peseta and devalued. But I think we have to identify the sources of tensions to try to figure out where the aftermath of the crisis is likely to take us and what kinds of measures are necessary to deal with it. And that may take us to Vivian's thing. I think the demands are different in different countries. I think that there are structural problems in every European country, as there are in every country in the world. And there are just as severe structural problems in Germany as there are in Spain or in Greece. They take a very different form because of what's long been known as the asymmetry of the adjustment problem between surplus and deficit countries. Those structural problems should be addressed. Austerity, especially in the deficit countries, especially in the major debtor countries like in Southern Europe and in Ireland, austerity is essential. I think, however, embarking on austerity measures too soon, as in the case, in my opinion, of the UK, is probably a mistake, both politically and economically, but particularly politically. Eventually, there will have to be adjustment. Eventually, there will have to be austerity measures, and eventually, countries like Greece will have to follow, in one way or another, the path of Greece of trying to get control of what is now has become an unsustainable fiscal burden. But I think that we also have to take into account that there are Europe-wide considerations in this rebalancing, that inappropriate focus on solely national adjustments to the problem will lead to inappropriate responses. That is, that there is a need for a European response, for whether it's regulatory, fiscal, monetary, crisis management, that leaving it to national authorities to, quote unquote, adjust the structural problems of the national economies will not do it.
Hans, do you want to respond first, and then?
The idea was to answer the question whether national monetary policy, autonomous national monetary policy, could now serve as a device to deal with the issues. Evidently, no. I would immediately concede one size fits all, leading to quite some dispersion in terms of real interest rates, was one of the causes. But there have been a number of many others. And by the way, we meanwhile all know what the causes have been. We are very much profiting from 2020 hindsight. I would have loved to see this argument in 2005, 2006, and so forth, when actually nobody was out with a diagnosis that this was an unsustainable thing happening there. Now, austerity. There's that big demand, the big claim that there should be some reshuffling of worldwide demand in order to get to the output potential. This is not a very brilliant idea, I would say. If we start with the diagnosis that we've had a credit bubble, this is the logical corollary to that is that we've had overaccumulation. And that's one doesn't only have to look at construction sectors in many of those economies. It wouldn't quite obviously not a good idea to produce demand in order to get to 16% of construction over GDP in Spain again. This is the most obvious one. But this over accumulation, of course, had consequences all over our economy. So what we do not actually know is where the potential output is. And moreover, we are not really sure about the multiplier effects of fiscal policy, the effectiveness of fiscal policy. So I'm now trying simply to explain why Europeans are rather reluctant to embark on the proposals which we frequently hear. By the way, it is, of course, also of the essence to take account of the fact that we have a much more developed social security system. Hence, our automatic stabilizers are significantly higher than those you have here. And poor old Germany produced exactly the same amount of budgetary impulse than the US did, if you just look at discretionary plus automatic stabilizing mechanism. So it is really, as Vivian says, growth. But is it growth in those old over-accumulated industries? That's a rhetorical question. Mm-hmm. Should we go for more of construction in Ireland? Or do we have to think about where growth should come from? So I'll stick to the point. Going forward, the adjustment has to do with the structural reforms, with the new supply side of our economies not going down the bad old road which led us into that mess. Maybe I should add, because I think Michael Londisman made two very important points very briefly. First, one should acknowledge that in terms of fiscal supervision, Europe is reading from the same script book. All the rules are the same all over Europe. Implementation might be different, but the
Fiscal, not financial.
Financial. The rules are basically the same. They're not coming out of Europe, by the way. In banking, they're coming via Basel through Brussels to Europe. So we should acknowledge that there's no national capacity of your own financial market rules. They are completely imported.
Shall I? Yes. Well, the point is who is coming in when there are problems in the banking system. So it's the supervision rules might be the same, but the supervisors who have the task to either intervene in the banks or recapitalize and so on are defined at the national level. Yeah? So I think the real problem is that we have a highly integrated banking system across Europe with enormous spillover effects, but in the end it's the national authorities who are responsible for putting in the money or letting them go if something goes wrong, which has very problematic aspects, especially for small countries, but of course also for host economies who are receivers of these banks. Let me come, well, I must say, all this talk about structural problems and so on, people are very, it's a bit like the debates I heard now in the US elections. One should be really much more specific what one really means. What are these structural problems? I mean, again, giving the example of Ireland, but even Spain, you can see very often that countries were actually quite attractive for real FDI before. Yeah, that's true for Spain and Ireland, and suddenly it sort of shifted away within a span very often of 4 or 5 years towards enormous credit boom, which was fueled by both demand and supply side. So I think Jeffrey is right that there is a structural problem here in the sense that catching up economies who in principle have the prospects of high real income growth are very attractive to lend money to and also to borrow because your prospects of getting high income in the future is there and therefore you're a good borrower. So this structural problem I think has to be dealt with and could be dealt with by a much tighter regulation. It could be a European-wide regulation of how this lending occurs And I think there are also specific possibilities of constraining lending to the building sector, the construction sector in the form of mortgages. I think this debate is global at the moment. I think the solutions will also be found to this issue. But it's a bit of a problem that we haven't thought about that before that, because the numbers were there. I mean, we could see explosive graphs in terms of credit developments, and nothing was done about it. So I think there's a real lacuna. On the issue of fiscal space, I think I'm more on the side of being cautious in the short run with a very synchronized austerity program. Of course, it is very important, and I think this is almost a common view amongst most economists. If you use this fiscal space in those countries where you can do it, you should at the same time put in place your program for medium and long-term sustainability. I think there's nothing original about it, but it's something which should be followed. There's not enough done about it, because the rule book of the European Union doesn't allow a proper addressing of sustainability issues. Yeah? It has a 3% rule which you have to obey within 3 years, and that's not necessarily the best and optimal way of dealing with long-term sustainability.
Thank you.
I focus on the austerity thing, and I ask the question, which is the country or the region which is quickly and significantly going into austerity? And the answer is the UK. It's not the application of Maastricht, it's not the application of German rule, of pressures, it's the UK for own idiosyncratic reasons. Why? Because this is an example of an OECD country among many others outside the Eurozone, which are in deep, very deep financial troubles. And more explicitly, the UK was the first country in 2009, in the spring, which was singularized by the ratings agencies, which put the UK notation under review, under negative review. And the ratings agencies after that did not say anything until the election, not to interfere with domestic politics. But the pressure was there above UK. So within the Eurozone, I think it's important to distinguish two situations. There are the countries where the fiscal situation was clearly unsustainable. The Greek being the extreme, Portugal being in a similar situation, less dramatic but similar. And these are situations which are of IMF rescue types. And consolidation, massive and urgent, there is no alternative. So it's well done, and this is going. The government did not explode, as Lucas said, and this is going to be the case. Otherwise, wouldn't they be in the Eurozone? They would be following the UK example. There is no alternative. That's simple. Regarding the other economies in the Eurozone, at the moment, and this could be a question in the future, they don't follow the UK example. For France, for example, a big economy in the Eurozone, France has adopted recently a reform of pensions whose merit is to show to the financial markets that the government is serious with financial questions and solve a problem coming into 2020. So I suppose that until that date, President Sarkozy will be reasonably cautious into the management of debt, of deficit reduction. He is for re-election in 2012, and so I don't expect austerity measures dramatically in 2011. The Germans, I go a little further than HANS-HELMUT. I think that the Germans in 2010 have an expansionary policy. Not much, but the direction is expansionary. And the reduction in 2011 is very modestly deflationary, very modestly. So the summary of this situation saying the whole Eurozone is going into austerity, I think is wrong and doesn't pay attention to the fact that situations are different, that answers are given and are given according to these different situations.
Yeah. Is the euro partly, at least, responsible for the crisis that we experienced earlier this year? And I think it is, let me give a typical two-handed economist answer. Now, on the one hand, I think it is fair to say that the euro has allowed wider margin for fiscally and financially irresponsible policies of some of its members, and especially in the South for three reasons. One had to do with low interest rates, that was already mentioned. I mean, rapidly expanding economies in Southern Europe pre-2008 would have needed higher interest rates than the ones that were adopted by the ECB. The second was extremely poor surveillance of national policies. And the third, which is also important, is that the framework that we had designed was meant to deal only with fiscal deficits. So if it had been properly implemented, it could have conceivably prevented the Greek crisis, but it would have not prevented the Irish and the Spanish construction and financial bubbles. Now, having said that, I think it is also fair to add that imagine what Europe would have looked like after the explosion of the global bubble if we had separate national currencies, and what competitive devaluations would have had as an effect on the European single market. So I think the balance sheet is rather positive. Now, I would perfectly agree with my German co-panelist that if you want to sort of recommend economic and political suicide to some of the members of the Eurozone, you can recommend to them that they exit the Eurozone and they also restructure unilaterally their debt, because that would be economic and political suicide. Now, and one word about fiscal consolidation. There is no doubt at all that many of the countries of the South and also the Western periphery, namely Ireland, need severe fiscal consolidation in the next few years because there's no alternative. Tina, so that's Mrs. Thatcher. But whether overall for the Eurozone as a whole, this is the appropriate margin and range of fiscal reflation, I hope it is not going to be a post-mortem that will tell us who was right, all right? Because if, and this is really my fear, I don't know what is the biggest danger of all. Obviously, there is the danger of rising sovereign debt, but there is also the danger of another recession with rising unemployment, and that would have serious political and social consequences. I'm not sure what's going to happen. I very much hope that the latter is not going to happen. But if it does materialize, so if the worst scenario materializes, then the implications can be dire.
Anyone want to respond? Yeah.
Well, so I think that there's some of the issues that have been addressed are fascinating. I would point out again, and before we open it up, just point out something, standing back a bit and thinking about the political economy. First of all, just on LOUKAS, I'm sure he didn't mean this, but financial irresponsibility takes two, right? Both the borrowers and the lenders. And so one thing that, as an outsider, I find very annoying is some of the rhetoric about the various bailouts. I was very struck when, in the Greek crisis, because I was asked to comment at various points, that we had a crisis of housing finance and then a bailout of the banks. And in Europe, they had a crisis of sovereign finance and a bailout of the countries. Well, they were exactly the same. The bailout was just as much a bailout of German banks and Dutch pension funds as it was a bailout of Greece. And so, I mean, the sort of the moralism of a lot of this discussion, I think, is very annoying to me. But then from a more analytical standpoint, I think that one of the things that I would anticipate is the predictable division between creditors and debtors within Europe, which unfortunately largely follows a northern southern European axis. Of course, the creditors in the current context want tighter money and more contractionary policies, and anything that's going to maintain the real value of their debt. And of course, the debtors want looser money and more expansionary policies, and anything that's going to lessen the real debt burden. So that's, I think, a conflict that's going to continue over the next 5 to 7 years within the Eurozone.
Thank you. I think rather than start with another question, I'm going to open it up to the room because we've had a lot of questions. They've already answered all your questions. Okay, then I'll go on to.
You got one there.
Oh yeah. Okay. Oh, sorry. Yeah.
I'm a Spanish tax professor. I have one reflection and one question. Reflection is Spain without the euro will be like Argentina a long time ago with the corralito. It's like we really are I don't think that we are thinking about leaving the eurozone. Will be a suicide. The problem with Spain, we talk about all the time. You should increase the taxes. Corporate tax is 30. Personal income tax is up to 43. The problem with Spain is tax evasion. The problem with Spain is this real estate bubble. The problem with Spain is we are in a nanny state. Most of us, we are functionaries. We live, I mean, we pay taxes, but most of us, we live by the money of the state. So we do have to make a lot of changes, not from Brussels, but inside our country. The thing is that nobody wants to do that because it's not popular measures. So it's not a question of taxes only, it's a question of big and deep changes in the normal structure of the Spanish system. Okay. And the question is, what about the new member states? How the economy of new member states affect the euro? Thank you.
Thank you. Next, I think we'll collect a couple questions, and please do, as you did, identify yourselves. I think Carl had his hand up first, and then.
Also, Kennedy's Cullen Weatherhead Center. When the euro started, there was this big debate in Germany at that time when Kohl came back from Maastricht with the abolition of the D-mark. Among two groups of economists, the one said it can only come at the end of integration, and the monetarists said no, it is an instrument toward integration. Looking back now, it seems to me the first group was probably right. The monetarists, I was then on the monetarist side at that time, made some assumptions which turned out to be wrong. The one assumption was that there would be a convergence of public policy. It would just produce it. And it didn't, as the Greek case shows. The other assumption was, well, if you forgot about the private debt, that has been pointed out. It was totally neglected in the debate at that time. And that turned out to be absolutely an explosive issue. Can the euro go on? That's my question. With such enormous differences, and the intervention from Spain there showed it, in the conceptions of welfare state. In other words, beyond the pressure toward coordination of fiscal policy, can the EU go on without some rapprochement with of the welfare state systems? I don't see it, because if we have these fundamental difference, one country retires at 55 and the other one at 68, it's not going to work.
Take one more question. But just to add to this one, you know, you've been talking about economic solidarity. Can this work without social solidarity too, which I think is really where you're getting at. Yeah. Please.
Eric Duchesne, I'm a professor of political science at the University of New York City and visiting researcher at the Weatherhead Center. I heard all of you, mention the different countries. Spain this, even you mentioned the South, France, Germany, and et cetera, et cetera. And it frustrates me a little bit because it seems that countries are not monolithic entities. It seems like no one is here. Jeff may be a little bit, and I'm especially frustrated with Jeff because because you don't know where I'm coming from. That there's no, it seems like because we're talking about the EU, there's no more factor analysis or sector analysis. not everyone in each country will be affected the same way by fiscal policies or monetary policies. It seems like, you know, it's a very wide brushstroke when you talk about, Germany and Germany's position. Not everyone in Germany is affected the same way. So I'm saying I'm especially frustrated with Jeff because Jeff did the pioneer work on applying Stoper, Samuelson, or whatever to finance. So now that I expressed my frustration, I said, so why am I frustrated? So why isn't there, because we're talking about the EU, are we veering away from a typical factor or sector analysis or class analysis, even if you want?
Renee, and then we'll.
Yes, René Haverkamp, Commission and Center of European Studies. If Delors had had his way, what he wanted from the beginning, not only monetary union, but economic union, what would have been the difference today?
Okay, thank you. Who would like to start? Michael?
Well, I think the basic theme which was drawn out initially is how much heterogeneity can the EU live with, no? And I think one shouldn't forget that one of the main advantages of integration is heterogeneity. Yeah? In fact, trade theory, FDI, growth theory would all point out that the big gains from integration comes from being different. Yeah, basically you can transfer technology, you can specialize, you can even out differences through also migration flows, etc. Yeah, so I think there are huge gains from being different. Yeah. It doesn't mean, that, of course, that there are not huge policy challenges with it, yeah, and a lot of them were mentioned. So I think, and I think we haven't exhausted or analyzed or have the answers how to deal with all those aspects of heterogeneity. Some of the macroeconomic implications were raised, and we know them. And if, for example, the negative real interest rates, we don't really have an answer for that. Yeah, it is a feature for such a heterogeneous, and I think the continuous bouts of credit bubbles will continue to exist because of the structural problem. You might modify it by stronger regulation, but de facto it's there. And many other tensions, I mean, like possibly migration, migration flows which create tensions on one side and economic benefits on the other side are also a feature of that. The adjustment of structures, which are the means by which you gain from heterogeneity, are huge costs and are seen as social and political costs. Yeah? So I think we should see both these two sides. In terms of the welfare state, I don't see necessarily that we can't live in a community which has a development of welfare states at different levels which reflect the level of economic development. Otherwise, you would say you can't have global integration between, let's say, Sweden and India, etc. Yeah? So you don't have, you have strains on certain structures, but you also have the possibility of maintaining social, different levels of social development, basically because it's compensated by productivity levels, quality of institutions, etc., which buttress different levels of welfare states. Nonetheless, I also agree with what you were saying, that there is definitely one, we spoke about many neglected arms of European policymaking, and I think the social policy arm is definitely one of them, which would also help very much in the legitimacy of the institutions. In fact, some concrete work which was done was poverty programs. Yeah, there could be, there has been a costing that to assure the lifting above an absolute poverty level would basically be cheaper than any of the bigger programs. Yeah, it would be cheaper than structural policies. So I think there is a lot of scope, and I think from a political dimension, this would be a great additional branch to develop. I wanted to mention something on the new member states, because that was, and that's definitely my area of research also. The new member states, except for Hungary, were all fiscally very prudent countries. Nonetheless, they were heavily affected by the crisis. Yeah? Even countries which were utterly, overly balanced in all respects, like the Czech Republic had a big slowdown of growth. So I think there shows another problem, I think, of governance structures. And of course, countries which are not members of the EU suffered even more, including countries which were on a relatively good path like Turkey. There are negative spillover effects from the integration process of the EU on the neighboring regions. Overall, I think, and I think that comes back to what is missing, the insurance principle, the pooling of risk, is a very much underdeveloped area of European governance. Yeah? Some of the problems in which Portugal is in, Spain is in, many of the Central European countries are in, would have been prevented. The big slowdown and recessions would have been prevented by the existence of bigger insurance institutions. I think the EU is moving in this direction, both on the financial side as well as on the fiscal policy side, but rather late. So everything has turned out to be de facto to be managed at the national level.
Who would like to go next?
Can the euro go on despite internal difficulties and divergences? And if we go back to the crisis a few months ago, I think there are three main elements there. Two have to do with facts and one have to do with perception. The facts were rising sovereign debt and large imbalances between members of the Eurozone. The perception, which I think was much more widespread in two places, Wall Street and the City of London, was that the Europeans had neither the instruments nor the political will to deal with the problems. And that's where they were mistaken. And they were mistaken because I think many of those people never understood the kind of investment, political and economic investment, that is associated with the euro. That the demise of the euro would incur a huge economic cost and also a huge political cost for the European Union. So the reactions we have so far in terms of changes in individual countries, in terms of reform of euro governance, are a response of somebody who has reached the edge of the precipice and realizes that, you know, it's the instinct of survival that takes over. Will this be enough in the future? Well, it's going to be a difficult ride. There's no doubt about it. But would you have an easy answer as to which currency you prefer to hold in the next 5 years, the dollar or the euro? I'm not sure.
I'm sure.
I'm sure, yeah, euro. No question about it.
I wanted to make two observations. It is completely right that academics have been criticizing the Stability and Growth Pact for very good reasons. In fact, I invited into the Bundesbank Mike Wickens to tear it apart. There's basically no analytical foundation whatsoever. Nonetheless, it doesn't suffice to criticize. You somehow need some sort of constructive handling of the issue. And there the relevant question is, what is your alternative? And I would surmise the Stability and Growth Pact, while not deeply rooted in optimal currency area reasoning, which would lead us to nowhere, hasn't been that bad. And now the real issue starts. Are we on a way towards improvement? And I do think we are. Second remark concerning financial markets. That has been even, there the flaw was much bigger in terms of Basel II. A colleague of mine at Freiburg University in the mid-1990s wrote that capital requirements as they are in Basel II were perceived to get into the Basel process would be highly detrimental. This has been borne out. So you listen, you do not listen to academics at your own cost, so to speak. Now we are reorganizing that. It's marvelous to see. I've been on the ABSB board. It's marvelous to see that all the critics, and I've been critics as well of the Stability and Growth Pact and of the capital requirements, liquidity requirements, are kept on. They are now in the new rules, integrated into the new rules. So I do think we're going in both dimensions in the right direction. Well, but we are living in a second best world, and we only have third best options. So our level of ambitiousness should be higher, no doubt about that. But I do think we're going in the right direction. That's why I'm sure which currency I would like to hold.
Thank you.
A few comments on the questions on Frieden and Carl. To be frank, I never fully understood the French proposal for economic government of the Eurozone, because in my view, government is by definition, if I may say, interagencies in the US or interministerial in European vocabulary. There is nothing which is an economic government. What we are witnessing is a step forward in this direction. It's not economic, it's financial. We are going into building a piece which was missing in the architecture, and we will go, as I said, in a direction of a better financial convergence. And this is, in my view, sufficient to cope with different systems. What was striking in the Greek system is not that the Greek retired early. It is that earlier than the Germans. It is simply that the actuarial profile of pensions in Greece was definitely unsustainable. That it was based on debt and not on transfers between working people and pensioners. But you can perfectly imagine an actuarially neutral system where people work 20 years and retire 20 years. The level of pensions will have to be adapted to this sort of situation. So I think it's possible to live. It will be more and more difficult because people will make comparisons, and there is the question of deficits, which will all of debtors and creditors, which will always be beyond. So I think that we should go in the direction you suggest. But my point goes much further than welfare policies. It's that if we go to to a financial government of Europe, what has been said, for example, by Michael, is that we needed to make budgetary discipline integrated by national culture, parliaments, and voters. Otherwise, if it's a diktat from Brussels, even if it is a good inspiration, it will be rejected. So financial convergence, in my view, comes back to what you mentioned as the first step, the first reaction of your colleagues in Germany. At the end of the day, which is a decade or 2 decades, the question of a stronger political integration will necessarily come on the table.
I think what I want is for the panelists to do is now pick up on this point, because I think that's very important, about political integration and the question of democracy. There's a lot of sort of technocratic governance going on right now. To what extent do you think that this could be democratized, should be democratized? Of course, what that means, I'm not quite sure, but I leave it to the panelists if they have any.
Gee, I don't know. I'll try to take a shot at it because it's related to the very valid point that Eric mentioned about domestic politics. I mean, we tend to think of these in government to government or nation to nation terms. I think, and this is specifically about the post-crisis environment. I mean, Europe, like most of the rest of the world, faces some real serious adjustment problems, and there are a lot of conflicts in an adjustment process between countries about who's going to bear the burden of adjustment, creditor countries, debtor countries, but also within countries, who's going to bear the burden of adjustment. I think it would be a mistake to conclude from some of the things that we've talked about or that some people have observed that the only way forward, and this is echoing something Michael said, that the only way forward is to homogenization of policy throughout the Eurozone. I think that's a mistake. I think that there are certain things within a currency zone that you do have to actually deal with from the center in some sense, especially instances in which national policies can impose real costs on other members of the zone. I think financial regulation is the most obvious current example. But welfare policy, social insurance policy, labor market policies, those can still be national to a large extent, and I see no reason for centralization of that. That does raise the democratic deficit issue. I mean, or let me put it differently, an exaggerated emphasis on the centralization of policy in the misguided sense, or in the misguided pursuit of Eurozone common policies, in the misguided belief or the, let's say, purposefully manipulated argument that they have to be done from the center, would be a mistake. Despite the fact that there were important component parts of the crisis that were due to the common, to many of the decisions made about monetary integration, that does not mean that every aspect of European policy and politics has to be centralized. And I think it's very important if we, as Europe moves forward, to keep in mind what can legitimately be kept at the national level, where democratic control is much easier to engineer. I think financial regulation is one area where the slippage between national preferences and a central decision-making apparatus is very, very difficult. Fortunately or unfortunately, financial regulation is really about clashes among special interest groups more than anything else. So, you know, it's the German banks and the Landesbank versus the Spanish banks and the Irish banks, and maybe democratic theory shouldn't care about that, but, you know, but when we talk about social insurance policies or welfare policies, labor market policies, those I think can still be primarily national and should be.
I suppose one way of looking at European integration would be as a succession of dynamic disequilibria. Okay, so it's disequilibrium that forces the Union to take measures and decisions that would have been unthinkable or inconceivable a few years back. What was agreed at Maastricht was politically the best that could be agreed at the time. It was, many of us knew that it was imperfect economically, it was imperfect politically, but the choice was nothing. It was not of having economic union, because economic union was not on. I mean, it was not on politically. And it will not be on for a very long time, whatever economic union means. So that's number one. So I think monetary union will be constant. I mean, we'll be going through different crises. This is the major crisis we are experiencing for the first time after 10 years of relative stability. And there will be more crises in the future, I'm sure. But the thing that keeps it going, really, and that's what I said before, and I'm convinced about that, is that the stakes are so high. And this is really the key motive. This is what has forced Mrs. Merkel to decide things that she would have never dreamt of deciding a few months ago, and also others to decide things that they've never dreamt of deciding. But yet, I think the decisions now about coordination of economic policies are raising some interesting questions about sovereignty, okay, and parliamentary sensitivities. We will be asked, governments will be asked to submit their draft budgetary plans before discussing them in national parliaments to the European Commission and other people who will be pronouncing on their validity, sustainability, on whether they're going to have an effect on imbalances and so on. So this is increasingly ruled by technocracy. It may be good, it may be bad, I'm not sure, but it may be a good thing. The trouble is this politically sustainable? It's going to create friction. So, right, we will have to deal with a new kind of friction, but friction there will be. And you might say, if you want to be cynical, there is likely to be perhaps less friction in countries that are heavily indebted and they are dependent on support mechanisms. But I'm curious to see what will be the reaction of the Bundestag if it receives messages from the Commission about the sustainability of its fiscal policies. It will be an interesting case to watch.
We have already watched that. It was great. No. With Germany. Germany. We have to remember that France and Germany were the first to go out of the pact, and we faced this situation, and we know the answer. The Commission, with all due respect, was sent to its studies. No, huh? Isn't this a good summary?
Yeah, I was in Brussels a few weeks ago and raised this question with people in the council about the issue of democracy given technocracy. And the response was, no, it's really increasing democracy because national parliaments will now be able to debate the budgets. And after, of course, but at least they'll be able to debate this. It won't simply be imposed from on high. So I'm opening it up to another round of questions. Yeah, Andy.
Yeah, I guess maybe picking up a little bit on
Introduce
the issue.
yourself.
Andy Martin, Center for European Studies. You mentioned a couple of times the asymmetry between the surplus and deficit countries. I wish people in the panel might explore that a little further, particularly with respect of to the distribution of the burdens of adjustment between surplus and deficit countries. I mean, this has been a problem throughout the history of monetary integration, the EMS and so on in Europe, and it's not resolved. And I guess typically or characteristically, the problem has been Germany, the surplus country, imposing the adjustment burdens on the deficit countries. What are the institutional possibilities, and even more difficult, what are the political possibilities of modifying the distribution of burdens, particularly or primarily on deficit countries?
Thank you.
Jürgen Holmqvist, I work at the Commission and I'm here at the Weatherhead Center. I thought it was interesting what Michael Londisman said, that the Maastricht criteria are very much on the public finances, which is true, of course, and that was not wrong, but there were some things missing concerning the private sector. I would agree on that, and I think HANS-HELMUT said something a bit similar, but more careful maybe. But it would be interesting to see, what do you think, or to hear, what do you think we should get out of this reform process that's now going on when it comes to the pursuit of other parts of the economy than just the public sector? What is needed to have the system function a bit better?
Thank you.
Arthur Goldhammer, CES. Jacques said that he exhausted his pessimism at lunch. My pessimism has survived until dinner. Several of you mentioned that your optimism rests on the idea that some kind of recovery is going to continue to limp along in Europe, and that failing that, and with an increase in unemployment, there's a potential for political instability. I agree with that completely. But I wonder, in the wake of yesterday's election in the United States, what you think is going to sustain this modest recovery in Europe? Where is the demand going to come from? What exactly does your optimism rest on?
Yes.
Friedrich Löhr, German Consul General. I was at a presentation by The Economist a few days ago, where they said that in the next year, the euro value would be, the euro rate would be at about 120 US dollars. This being so for a number of reasons, the main one being the insight in the fact that Greece would have to have a rescheduling not later than 2013. Is anyone of you willing to comment on this speculation?
Greek reschedules.
Oh, yeah.
I think that's.
Those are some
that's
fairly
it for
diverse
this,
questions.
Yeah. So, yeah, Jeff.
Let me try to, mostly on the asymmetry issue, the adjustment burden, which is related to the rescheduling, and I'll avoid this, the recovery, and leave that to pure faith or to others. So. They are related, obviously. They are related, but so I think the distribution of the adjustment burden, the surplus deficit adjustment burden issue, is a crucial one. One of the reasons it's always been asymmetric is that surplus countries are under very little pressure to reduce their surpluses. I think what's new, or what I anticipate from the current situation, is the German or Northern European surpluses have relied on a very an almost unremitting appetite for imports on the part of their customers, especially in the South. Much of that appetite for imports has been debt financed, just like the American appetite for imports was debt financed. And I think that both the appetite for financing and the appetite for imports more generally is starting to dissipate. So Germany, to run surpluses, it has to sell its goods. And if its markets are not drying up, but if its markets are more restricted, both because of the austerity measures and because of the great difficulties of financing, then I think it will be forced to adjust as well. That's the first point. And the second part is the more political one, which is the adjustment burden explicitly with sovereign debt. There, I think it is inevitable that there will be restructuring of the German debt. of the Greek debt. Inevitable. And all the Canton obfuscation about no restructuring was simply to try to delay the inevitable until perhaps 2013. I think it's, and not only is it inevitable, I think it's both politically and probably morally appropriate. In that in every debt crisis, there's always a restructuring in which both the creditors and the debtors take a haircut. So I think that there will be adjustment on both sides, and there'll be argument over who pays more or less.
Well, on these surplus and deficit countries, it's well, of course, a good thing would be if one contains things before they become unsustainable, these imbalances. In fact, it was interesting, this Geithner proposal at G20, which sort of sunk, of course, but it attempted to speak about certain quantitative restrictions on both surplus, symmetrically on surplus in deficit countries, or at least to give signals to have to do something about it. Probably the EU can go a bit further than the proposal by Geithner, because it is, although it's very, very problematic to give a particular number. I mean, we are worried about the 3% fiscal policy rule. The 4% surplus deficit rule will similarly be without much foundation. So underneath that, of course, must be a rather sophisticated analysis of what is sustainable in terms of external imbalance for a debtor country. And in the final analysis, of course, it means also an unsustainable situation for the surplus countries to build on it. Yeah. I mentioned before, a lot of the reason for things going out of completely away from sustainability is a financial market issue again, yeah? Because the misalignments of real exchange rates was really the rather short-run dramatic influx of money in a short period of time. It's not the underlying. There is some of that also in some countries, the misalignment between productivity and wage developments. That's another area where there are all sorts of proposals to discuss a bit more how the alignment between productivity and wages can be more coordinated in some way. But I think it is, to an important degree, the real exchange rate developments are a function of, again, controlling and regulating financial markets. If that is done ex ante, plus alarm bells ringing, if one sees these very strong divergent movements, I don't know what instruments of arm twisting one can install, but at least one can give much more evidence on that and give it a routinized way of making it transparent, which it wasn't in the past. Actually, it was another neglected area. I think one could deal with it. On who bears the cost, I fully agree with Jeffrey. I think we need properly regulated and way of who carries the burden in the case of debts becoming of defaults, both private and public defaults. I think the stability facility and so on is going in this direction. I think it's correct to deal with that, and it will actually have a positive impact on signaling to the financial markets in terms of interest rate differentials that things are going in the wrong direction. Well, in terms of growth, I think the two big factors about European growth, which make one even more pessimistic in the future than currently, is demography and the inability so far to counteract demographic problems with more, with dealing with the migration policy issue in a more constructive manner. I think it will be an adaptation process slowly and so on, but at some point Europe will have to tackle that very strongly. And the second one is, of course, if one comes to the US, the main problem of not being able to deal with the Lisbon agenda in terms of innovation, R&D, innovation systems, venture capital and so on. I mean, these are all well-known things, that they are important growth constraining factors in terms of the dynamism of the European economy. It has not, I think, too much to do with the very short-run problems which we were discussing mostly before in terms of conduct of fiscal and policy issues.
I'd like to make two remarks. The first has to do with Andy's question on imbalances. There are many Germanys, even in Germany. the remark on the regional dimension. Germany is basically a setup of, let's say, 6 to 7 clusters, highly integrated, highly performative. Now let's accept the diagnosis. This is a problem. What would be the lever, the instrument of policy to rein that in? Do you assume that the German chancellor would go to Ludwigshafen and tell BASF and others to be less competitive? So you simply do not have an instrument to deal with it. And we have many regions in Germany which are, of course, in terms of per capita level on a very low, to be allocated on a very low scale. So this issue cannot be dealt with via monetary policy. This is quite obviously a topic for substitutes for monetary policy, in particular labor markets, and here wage flexibility. The second point I'd like to emphasize has to do with Ardo Goldhammer's question: where does the demand come from? In fact, it will not be the demand which was in these over-accumulated sectors of the economy, and we shouldn't shoot for that. But we might, and there we are simply at a loss to give you precise answers, but we shouldn't be so negative in our capacity to come up with new products, new technologies whatsoever. So as a rule, we do not accept that lump of demand argument. We do think there are possibly other ways where new demand, viable demand, can be created. I'm not negative with that regard. In fact, many of these Germanys, which are Northern European countries, have been written off on a frequent basis, but they've been adapting to things. They've been reorganizing their production facilities, and hence that's why they are so competitive in world markets. In fact, they are the only countries who gained market share, if you look at the OECD statistic. Perhaps a final point, because I forget to mention it, an integrated financial area, of course, needs not only integrated, as Michael Landesmann highlights correctly, integrated the same rules. It also should have some sort of a coordinating facility above the national level. And we are going in that direction. We do have European authorities in banking, in securities markets, and in insurance and pension funds. You might not be, and I'm not satisfied with that, but we are going into the right direction. And I'm in particular do think it's important that we now have a European Systemic Risk Board, because many of the issues we see as problematic, completely share your view, cannot be dealt with a very broad-brushed monetary policy tool. You have to really use regulatory devices, which the Spanish, by the way, did with the dynamic provisioning in 2002 and 3, against heavy critique from the center, from Brussels at that time. But just to make that point, also there we are, in my eyes, going in the right direction.
Two comments. Number one, regarding I think the most difficult question we have discussed, which is a surplus deficit country as a problem. Someone said that Germany at once will be forced to adjust. Frankly, I doubt that. I doubt that because there is a misperception of the sort of problem which has been raised by Greece. And it's striking to hear German friends and colleagues say that the rescue of Greece is something where the Greek have taken the number of their credit card, the German credit card, and will be able to use it at their benefit. And I was extremely struck by the fact that all the debate in Germany in the spring was based on a completely wrong assumption that the rescue of Greece was budget money. It's not budget money, it's treasury money. And this is a big difference because treasury money. This is the money, the sort of rescue which has been performed by the IMF for decades. And it is a profitable business. When the IMF lends money to countries in difficulty, you mentioned Argentina, it earns money everywhere, in Turkey, in Russia, in Thailand, everywhere. This is a profitable business. And this is something which which never appeared in the German debate. And I asked why, and the answer is because last time we were in this situation, it was Eastern Germany. And in that case, we had to pay for real money, not for treasury money. And this makes a big difference, I think, in cultural terms beyond all the rest. It's not close. The situation where the Germans could change their views on this process could change. Finally, a word on democracy, Vivian, because I would come into defense of what you heard in Brussels. The previous situation was a situation where the technocratic process kept the parliaments completely outside anything regarding the financial situation of the different countries and their externalities. No one never told the Greek parliament, the Greek voters, the Greek media that the incredible pensions reforms were in effect paid by debt and German savings. At once in the future, the German saver will wake up. So it's good that the technocrats only publish the materials which are part of the decision-making process. If this is not that way, the information will come through spreads on the financial markets, because this will be recognized and markets will now adjust much more quicker than previously. So this should not be dismissed as something which is not democratic. I think it's a step into a direction which was also missing. Another important point, and I conclude, is the role of the European Parliament, which has been increased in significant ways, not in the matters we are discussing now about national deficits and surpluses, but for example, we discussed also financial regulation, and the power of the European Parliament has been testified in the summer when the Parliament made a strong point about the creation of the new agencies. So even on the democratic side, I think that pieces are adding to the previous ones in the good direction.
Great. And Lucas, last word.
Oh, I find it interesting that the official debate sort of on surplus and deficit countries is much more explicit and fierce at the international level than it is at the European level. All right, I mean, because that debate is waged by Americans against Chinese. Okay? It is much more implicit, diplomatically and politically correct in Europe because it's more sensitive. Number one. Number two, now this four-letter word, which has many more letters, which is restructuring of sovereign debt, which is, of course, not officially is not on the table. And I think that the German proposal for a crisis resolution mechanism as part of a permanent crisis management, which would make provisions for part of the cost to be borne by lenders as opposed to taxpayers, is a very correct one and will actually facilitate orderly restructuring negotiations in the future. But it is not for tomorrow, I think.
Thank you all for a very stimulating